Hello everyone, welcome again. In this lecture we are going to start our new topic, which is on the inheritance tax. Now, like the name says, inheritance tax, so whenever your parents own something and when they die, then you are the next owner of them assets, assuming that they have written that in the will, right? So when someone owns some assets and when they die, so the new owners will inherit them assets. So then they will have to pay eventually some tax on that, because the deceased person is already died anyway, so he can't pay the tax on that, right? Now sometimes you have to pay on death. So whenever the deceased person who was the owner of the assets, so when he died, then the person who is the new owner will have to pay tax on that. But in some cases what happens is that whenever a deceased person who will eventually die, whenever he gives any lifetime gifts, then they will have to pay lifetime tax as well, right? So basically it is on the property of, it is on the gift of the property. So whenever you are gifting some property, you have to pay inheritance tax. So you might have to pay during lifetime, and you could pay sometimes you have to pay on death as well, right? So I've made a little pro forma on the board here, which is very, very important for you to note down. So please make sure you note down this pro forma, and then we will continue with the help of this pro forma, and we will read our notes as well. So in this table, as you can see, I've written down the time of transfer. Now what time we transfer an asset. So we can either transfer an asset during our lifetime. I won't say myself, I won't say we now, we will say someone, because we don't want to die, do we? So if someone transfers an asset, they can transfer at two different times. So they can transfer during lifetime and they can transfer at death as well. So there are two times of transfer. So either they can transfer during their lifetime or they can transfer at death. Now if they transfer asset at death, say for example, so if the if we talk about the death transfer, then there will be on the death time of on the death time. So whenever someone has gifted something on death, it means they have inherited on the death, which was part of the will. Now in that case, they will have to pay tax on death estate. So we will make a death estate of the deceased person. So say for example, when he died, he owned a house, he owned a villa, he had some liabilities to pay. So we will add all the assets, we will deduct some liabilities, and on the eventual amount we will have to pay tax, right? Now we are talking about the death estate. Now let's look at this thing here. It says a lifetime transfer. So do we have to pay any lifetime tax on that, on death estate? No, I don't think so. We don't have to pay any lifetime tax on that, because it was transferred on death. So when it was transferred on death, life is gone anyway, so there is no tax during lifetime. It is not a lifetime transfer, it is a death transfer, right? So we will have to pay tax on death, like it says above that, death transfer. So we will definitely have to pay tax on death as far as death estate is concerned. Now what was that death estate? It was a type of transfer, right? So it was time of transfer, and in time of transfer there is one death transfer, other one is lifetime transfer. We looked at the death transfer. So when there is a death transfer, there is only one, which is a part of the death estate, and we don't have to pay any tax on death estate. It is very, very common, because when someone died, there is no lifetime tax anyway, because that person is died anyway, its life is gone. So there is only death tax on death estate, right? Now if we talk about the lifetime transfers, because the death one is already done, so only one is left, is lifetime transfer. Now on lifetime transfer can be of two types. If you see here, type of transfers. Now during lifetime we can make a gift either to an individual. So if Mr. A gifts to Mr. B, or Mr. A gifts to a trust. So there are two different types of things. So when Mr. A transferred to another individual, Mr. B or Mr. C or whoever, so when one individual transferred to another individual, it is called potentially exempt transfer. So as you can see here, it is PET, pet. So it's not the pet that you keep at home, obviously. So it is potentially exempt transfer. So when one individual transfer a gift to another individual, it is potentially exempt transfer. But what about the one if someone transfer to a trust instead of transferring to an individual? So if someone transfer an asset to a trust instead of the individual, then that gift is called CLT, chargeable lifetime transfer. Now the question arises, why would someone be transferring to a trust instead of transferring to an individual? The common reason is, if, say for example, if someone is at the old age and they have got one home, and if he transfer that house to his son, his son might kick him out of the house, so he will have no place to live in. So in order to save this situation, in order to avoid this situation, what do they do is that person will transfer to a trust, and then the trust will be looking after that asset, and when this person dies, then the trust will transfer to the individual. Right, so that's the reason behind the transferring to trust. Some cases what happens is that people transfer to a trust because they are too young to take care of the asset. So when they comes of the age, say for example 18 years, then the trust will transfer the asset to the beneficiary, whoever the ultimate owner will be. Right? So our topic is not that. We are studying just the inheritance tax. So there are two types of transfer. I'm talking types of transfer. One is potentially exempt transfer from individual to another individual. Another is chargeable lifetime transfer, so from one individual to a trust. Right? Now as you can see, types of transfer: potentially exempt transfer from one individual to another individual, chargeable lifetime transfer, CLT, from one individual to another trust. Right? Now, if we talk about the potentially exempt transfer, HMRC says that if you transfer an asset from one individual to another individual, you don't have to pay any lifetime tax for inheritance tax purposes. Right? So for potentially exempt transfer, lifetime transfer, we don't have to pay any tax on that. And it says lifetime transfer calculated using Nil Rate Band during lifetime. Now what is the Nil Rate Band? Nil Rate Band basically is an exemption of £325,000. So up to £325,000, up to first £325,000, you don't have to pay any tax. Tax rate will be at the rate of 0%. So while calculating the value of the transfer, we will deduct the Nil Rate Band out of that, and on the remaining amount we will have to pay tax. So that's why it says calculated using Nil Rate Band during lifetime. Now, Nil Rate Band of £325,000, we will have two Nil Rate Bands. One is during the lifetime, and other one is at death. Right? So on lifetime transfer, we will use the Nil Rate Band during lifetime, and on death transfers, we will use the Nil Rate Band at death. Right? So there are two types of Nil Rate Bands. We will have two Nil Rate Bands. Anyway, if you transfer an asset from one individual to another individual, there is no tax on that. It is exempt from it is exempt from inheritance tax. So we won't have to pay any we won't have to pay any inheritance tax on pet during our lifetime. Right? And if we come to death, we will have to pay inheritance tax if the individual dies within 7 years. Right? So we will write down, yes, we will have to pay only if individual or the transferor, we can say transferor basically, or the transferor, or if transferor dies within 7 years of making gift. Right? So he will have to pay tax only if the transferor dies within 7 years of making gift. What if he survives for 7 years? What if the individual who made the lifetime gift, if he survives for 7 years, then they will have to pay no tax at all on potentially exempt transfer. Right? So there will be no tax on the potentially exempt transfer if the individual dies for 7 years, if the individual survives for 7 years. So if individual makes a gift to another individual, and that is called a potentially exempt transfer, right? So that is the first thing. Now if the individual makes a lifetime gift to another individual, there is no lifetime tax on that. And if the individual survives for 7 years after making the gift, if the individual does not die, then there will be no tax on death as well. However, if individual dies within 7 years of making the gift, then there will be inheritance tax on potentially exempt transfer. Right, so our potentially exempt transfer is done. Now the next one is a chargeable lifetime transfer, when individual gifts to another trust. So individual does not give to another individual, when individual transfer to another trust. Right, now in that case, a lifetime transfer, you will have to pay tax on the lifetime transfer, and it will be calculated using the Nil Rate Band during lifetime. Right, and on death as well, he will have to pay on death again only if individual or you can say transferor individual dies within 7 years, only if individual dies within 7 years. Right, now in that case we will have to take the gross amount. Gross amount must be used. Gross amount must be used. Right, now what is the gross amount? Now the gross amount is the net amount, whatever the amount of transfer of the gift will be here. Right, so transfer of gift, whatever the amount of transfer of gift is during lifetime, plus the tax which they have paid during his lifetime. Right, so amount of the value of the asset, value of the transfer during lifetime, plus the tax which they have paid during lifetime, that is gross amount. So we will have to take the gross amount when we are calculating tax on death. We are calculating tax on death on chargeable lifetime transfer. We'll have to take gross amount. Right, having said that, say for example if individual transfer to another trust, so one individual transfer to another trust, that is chargeable lifetime transfer. Will they have to pay lifetime tax? Yes, they will have to pay lifetime tax. What if individual survives for 7 years? Then it will be exempt. They will not have to pay any lifetime tax. However, if individual dies within 7 years, then they will have to pay tax on the gross amount of the transfer. Right, now let me share the screen with you, or let me share the screen with you so that we can read the notes together from our notes about inheritance tax. If you move to page number 49 of your lecture notes, I assume that you have noted down whatever I have written on the board. If you haven't noted down, please just rewind the video and just note down whatever I have written on the board. Right? So, as you can see on your screen, inheritance tax. Maybe 1 second. So, all transfers of assets worldwide made by persons domiciled in the UK, whether during lifetime or on death, are within the charge to IHT, which is inheritance tax. Chargeable person for inheritance tax purposes are individuals and trustees. There are two main chargeable occasions for individuals. So chargeable occasions means time of transfer. Now in the notes it says there are two chargeable occasions. As I said to you on the board, there are two types of, and there are two times of transfers. One is lifetime transfer and another one is death transfer. So as you can see in your notes, it says number A, gift made during lifetime and asset transferred on death. So there are two types of times of transfer. Then it says inheritance tax in the tax year 16-17. So first £325,000 we will get the Nil Rate Band, so there won't be any tax during lifetime. However, if it exceeds this limit, then the tax rate is 40% for inheritance tax purposes. Right? And it says note half rate on lifetime tax. Now this tax rate which you can see on your screen, 40%, and this is the death tax rate. However, if you're paying during lifetime, you will have to pay half of that, which is 20%. Right? So the tax rate during lifetime is half of what is at death. So death rate is 40%, whereas lifetime tax rate is at the rate of 20% only on the excess over nil rate band. Right, after that it says lifetime transfers. Now we are looking at lifetime transfers. If you can see on your notebook, that's why I've asked you to note it down so that you can see on your notebook. So notebook, on the notebook, if you can see, we're looking at the lifetime transfers. Now it says there are two types of lifetime transfers. One is potentially exempt transfer, another one is chargeable lifetime transfer. Now if you want to read it yourself, you can read. After it says PET is exempt from inheritance tax when it is made, as you can see on your notebook. So it is exempt when it is made. So it is exempt during lifetime. And it will remain so if the transfer survives for at least 7 years from making the gift. If the transfer dies within 7 years of making the gift, it will become chargeable to IHT. So as you can see on your notebook, on death you will have to pay tax if the individual dies within 7 years. However, if he survives, then they will not have to pay any tax. Right? Now let's look at some exemptions. So how to calculate the inheritance tax? So first of all, we'll take the value of the asset which is gifted, then we will deduct few exemptions out of that. Now what are these exemptions? Let's see. So first of all, it says these are the exemptions which apply to potentially exempt transfer only. So these are the exemptions which apply to PET only. First of all, it says small gift exemption. So if someone transfers 250 pounds to as many people as he wants, that is small gift exemption. So up to 250 pounds cash award that can be paid to as many people as you want. However, if it exceeds 250 pounds, that is not exempt. So as you can see on your screen, it says first 300 sorry, not this one, outright gift of individuals outright gifts to individuals totaling 250 pounds or less than that per donee in a tax year are exempt. If gift total more than 250 pounds, the whole amount is going to be chargeable. A donor can gift 250 pounds to as many donees as he wants because it is exempt under the small gift exemptions. However, please remember this exemption, small gift exemption, only applies to potential exempt transfer. Next exemptions which we are going to look at now are the exemptions which apply to both potential exempt transfer and chargeable lifetime transfer. Now these are the exemptions which apply to both of them. So what are these exemptions? It says annual exemption. So annually 3,000 pounds is going to be exempt. And another good thing is that we can carry forward unused annual exemption next year, and we can use that after using that year's annual exemption first. So we'll use the current year's annual exemption first, then we will use any brought forward annual exemption if there is any remaining one. All right. However, another thing as well, we will have to deduct all other exemptions first. So we'll take the value of the transfer, then we will deduct all other exemptions, and the last exemption which we can deduct is annual exemption. We can deduct it at the last. So first we will have to deduct all other exemptions. Right? Now you can read it yourself. After that it says gift in consideration of marriage. Now whenever someone is getting married, you can give some gifts on occasion of marriage. Now that will be exempt as well. Now how much you can give, it depends on the relationship with the wedding parties. So gifts in consideration of marriage are exempt up to 5,000 pounds if it is from a parent of a party to a marriage. So if he's a parent of the groom or the bride, so they can give 5,000 pounds to any of them, but only the parents of the party to the marriage. Then 2,500 pounds if it is a grandparent, and 1,000 pounds if it is from a friend. So it could be any of them. Right? Now these exemptions which we are going to study now, these also apply to death estates. So these will apply to potentially exempt transfer, chargeable lifetime transfer, and death estates. Right? So there are three types of transfer, as you can see on your notebook. There are information, the table which you have noted down from the whiteboard. So there are three types of transfers. One is potentially exempt transfer, then is CLT, and the last one is death estate. So these exemptions will apply to all of them. It says gift transfer between spouses. Any transfer of value between spouse, if you give to your wife or she gives to you, it is going to be exempt from inheritance tax purposes. Normal expenditure out of income. Now if you pay something which does not harm your way of living, so if I am a millionaire, if I give £100 to someone, it won't harm me. If I give £1,000 to someone, it won't harm me. So that is normal expenditure out of income. It is also exempt. So what is the condition of expenditure out of income? So inheritance tax is a tax on transfer of capital, not income. So a transfer of value is exempt if it is made as part of the normal expenditure of the transfer. It was made out of income instead of capital, and it leaves the transfer with sufficient income to maintain his usual standard of living. Then it is going to be exempt because it is just a minor amount from the person who is giving the gift. Please remember again, these exemptions will apply to all of the types of transfer: PAT, CLT, and death estate. Right? And also please remember, these exemptions, we will deduct these exemptions first, and the final exemption which we will deduct is annual exemption. Right? Now, evaluation of assets for inheritance tax purposes. Now say for example, if I have made a gift of shares, and how to calculate the value of that gift. So whatever the market value is, will we take that amount or what? Now, because if say for example, if I held 1,000 shares in a company, and I am giving gift of 800 shares or 200 shares or 300 shares. Excuse me. So say for example, if I held 1,000 shares in a company and I am giving away 200 shares to my son, right? Now I am giving 200 shares to my son. Now these 200 shares I am giving out of my own shares. Right? Now if I am giving out of my own shares, now the market value of them 200 shares will be different than the amount which I am losing. Right? Now what happens is that you might have studied financial accounting or performance management. Whenever you are going to buy shares in a company, it will depend on how much percentage you already hold in that company. According to that, the price will be given to you. Now say for example, if the share capital of the company is 1,000 shares, you already hold 100 shares, it means you own 10% in the company, right? You already own 10% in the company. You ask for 200 more shares. Now they will give you these 200 shares at expensive price, at higher price. Now why they are giving it at the higher price? Because your holding in the company is going to increase, right? You will have significant influence in the company. Now assuming you hold 30% shares in the company, and then you again buy 20% more in the company so that you can have 50% shareholding in the company, then they will give you little expensive. We will change the scenario. You already hold 45% shares in a company or 50% shares in a company. Now say for example, if you hold 50% shares in a company, now you only need extra 1% so that you can have majority shareholding in the company, and you can influence the company. Now the extra 1% shares, the other shareholders will give you at very higher price. Reason they will give you at higher price is because they know the importance of their 1%. Because they know when you're going to buy them shares from them, you will have your own company because you will be the majority shareholder in that company, right? So that is the reason that it depends on how much percentage you already hold, how much percentage shareholding you already have in the company. Then the shareholder who is selling you the shares, then they will give you the price, right? Now say for example, if you already hold 50% shares, the extra 1% is going to be very, very expensive. Likewise. So I will come to our topic, which is diminution in value. Whenever we are calculating the value of the shares, whenever we are calculating the value of the transfer, so whatever I am giving to my son, we won't take that value. We will take the value of what I am losing, not what he is gaining, right? Now how can we do that? You might be thinking that it will be exactly the same thing. What he is getting is what I am losing. No, it's not like that. We will see a question on that, then you will understand this thing better, right? Now let's see this thing, dimension in value. Give me 1 second. Right, so it says the measure of value of transfer with the lifetime or at death is always the loss to the transferor, the diminution in value of his estate, not the amount gained by the transferee. So how we calculate that? We'll see total value before transfer, so total value of the transfer before transfer, and less total value after transfer, and that is the amount which is called diminution in value, decrease in value, and that diminution in value we will take as transfer of value. This is the amount which is gifted. Out of that we will deduct exemptions. After that we will calculate I will calculate inheritance tax, and first £325,000 is going to be at the rate of 0%, and excess is going to be at the rate of 40% if it is at death, and 20% if it is during lifetime. Right? So that is a diminution in value.